All right. Good morning, everybody. I'm not sure where you're at, but if you're in the Buffalo area, it's probably a great morning to be inside. And I know that I'm probably not the most exciting speaker, but at least we are here and we're doing taxes and something to do on a rainy morning. So hopefully we'll have everybody get something out of this morning. Wanted to do a couple logistic things. I know some things. Everybody that's been turning the homework, it's been great. Everybody's doing a great job. There's a couple different ways. I've had people kind of ask, how do you want us to turn in the exercises? How do you want us to turn in the problems that you do? So we're going to kind of go through that. Typically, I make the expectation, or the assumption I should say, that not everybody has a scanner. So all I'm asking is that you just type in those exercises that have true false, multiple choice, fill in the blank. I'm not asking you to recreate or anything like that. The ones where they have you do the practice problems in the exercises, where you do the forms or maybe fill something out. If you would like to turn them in and you have the capability of scanning, from printing from the book that you have that's on the thumb drive, that's great too. But, just typing them in the body of an email, that's perfect. That's perfect, okay? And as I go along and I see how everybody's doing on the exercises and things like that, I may only ask you to turn in specific ones as far as the ones that I feel the content is something that is most important, okay? The other thing was that I had some questions about the problems. So I'm going to kind of show that for a second here. Basically, what you are going to do is when you're done with the problem, I gave you a couple different sheets, and I think there was some confusion there. One is a backup and restore. That is to get the return out of TaxWise or off your computer onto your thumb drive. So if you're somebody that, is using the computer someplace and you want to go someplace else to work on the homework, that's what that one is, okay? The other one is print to PDF. So we're going to kind of go through that real quick, just as kind of an administrative thing in case we have some people coming on. Again, you'll be able to come back to this, as far as the recording, so you'll be able to see what's going on with it, okay? All right, so if I am in TaxWise, I will be, where I am here, and I'm going to open return that I have. That we'll get Charlie Brown open here in a second. So give me 1 second. Okay. So I have my friend Charlie Brown and his spouse Lucy. All right. And just as a little fact for everybody that loves trivia, that is really Charlie Brown's address, 1770 James Street. He doesn't live in Buffalo, but that is really his address, okay? But when we're in on this and you've completed the problems, we'll do some more problems today. You have a choice up here. It's a tab up at the top that you see up there. When I talk about tiles or something like that, usually what I'm referring to is the things across the top. Okay, so usually when I refer to tiles up here, I kind of put it in a red box up here, but I'm usually referring to those gray tiles that are right above your tax return. Okay, so those are the tiles that we're talking about. All right, so that being said, if you're up here, you see the one that has a little printer. It's print return. Okay. And it brings open the window. And it's already defaulted for the file copy. And all I want you to do is print to PDF. Okay. So right there on the left is where you have print to PDF. Hold on 1 second here. All right, so we have that. Sound problem. Is everybody else, if you can type in the chat, let me know. Can everybody else hear okay? I know I have everybody else's mics muted right now, so if you can type in the chat. All right. Okay. So if you have any questions, just type in the chat there. Okay. All right. So it looks like we're good on the sound. Okay. But as I was saying there, we have, you know, on the right side, we got print to PDF. So when I hit that print to PDF, where it says file prefix, okay, just type in whoever the name is so you can keep track. I just do the last name there. All right. And then where you want to save it to, you can just save it wherever you want to. Typically, so that I can find them quickly, if I'm doing something, I'll hit save to my desktop. Okay. And then once I hit OK, it'll show that it's printing that. And it's putting that file together for Charlie Brown, and it'll put it right on my desktop. Okay, so it created a PDF, and it's now on my desktop. It'll be the little icon that says PDF, probably say Brown below it, and you can just attach those to the emails. Okay, again, I will take and just have specific problems. Again, with the content starting out, I just want to see how everybody's doing with the problems, so as many as you can get in. The other thing too, as far as the homework and the problems, the one thing I will say is that we want to make sure that that you try to get in best you can. I understand that everybody has other things going on, okay? So, that's, I appreciate you taking time out on a Saturday morning, or if you're working another job and things like that. And obviously things happen in life and family, but the best you can do to get it in and just stay caught up, that's great. I usually say 5 o'clock Friday. That gives me some time at night to kind of look and see how the homework's going for everybody, how things are coming in and stuff like that. So, just the best you can do on that. Okay. Again, as we go along, the homework that I'll require to see will be narrowed down a little bit, because there'll be specific exercises and or workbook problems that I'll have you do that are a little bit more specific to the content I want to focus on. Okay. All right. A couple other things that I want to have here. They are, just want to kind of share something with you here. The IRS has started to come out with the forms, and you hear this infamous thing about the being a postcard. Okay, so this is a draft right now of the new 1040 postcard. Okay, from your chapters that we've already done, a lot of this stuff will look familiar. Okay, all right. Let's see, if you have share on, if you go down to the bottom, there should be a red bar that says stop share. Okay, so make sure you're not sharing the screen. I'll be the one sharing the screen. If you share, sometimes that'll pop up with everybody else. Okay, so if you go down the bottom, yours might be at the top. It depends where your toolbar are. There should be a red thing that has a white square that says stop share. Okay, but this is the front of the postcard, and this is the back of the postcard. Okay, really all they've done is they've taken and just taken parts out of the return. Some of the next few chapters that we're going to be talking about, they've created what they call schedules 1 through 5. Inside, I know it's hard to read where it says draft, but inside here, if you look at the little line that shows up here, that's 11, and it says B, it says add any amount from Schedule 2, okay? Well, what Schedule 2 is the section calculating tax. All right, we're going to be talking about non-refundable credits, refundable credits. They each have their own little postcard, okay? So basically what I'm saying is it's a little smoke and mirrors. Really what they've done is just kind of taken the old 1040, taken sections out of it, and put it on separate schedules, okay? And yes, for those of you that are conservationists, it does look like we're going to be wasting a lot of paper. Hopefully our software is such that it'll move the front of the postcard up onto one page, and we won't have all these blank extra pages. You know, the 1040EZ used to be one page that you could print out. You know, even there is no 1040A and 1040EZ anymore. So hopefully, like I said, you know, they figure this out, and for printing and purposes, that it looks a little bit more, you know, compact as opposed to all the blank paper that we have here. Okay. All right. Okay. What we're going to do starting out, if anybody has any questions about the exercises, we had, let's see, we did some work. 1 and 2, I mean, the exercises weren't too bad. You know, most of it just had to do with the headings and such. But if there's any questions, that anybody was curious on any exercises they'd like me to go through, you can take and just type in the chat there, and we'll try to address them. Like I said, everybody looked like they did pretty well. Again, for those that were here last week or watched the video, you can check your work at the back of Volume 2. There is an answer key for the exercises and the quizzes. What I'll do is for the problems, what I'll start to do is when I send out the link, send out the link to the videos, I'll send out the homework assignments, and I'll also put in there the answers to the problems from the workbook, what the refunds and or balance due would be. Okay, I got one for, let me just grab a pen here and a piece of paper so I can write some of these down as they're going by. Okay. All right. And 2G. Okay. Let's see here. We had, okay, so we had 2G. All right. And David, the question, how do you get to the quick link on the TaxWise program? The quick link, what quick link are you referring to there? Is that the shortcut, or is it the software? David, are you, let's see, I'm going to unmute you, David, so that. Okay. So David, could you let me, can you unmute your computer if you want to ask that question? I'm not sure what quick link you're referring to. Oh, as far as navigating between there. Okay, we'll go through that in just a second, okay? And let's see, 2A, number 6. Okay, all right. First one we had there was the, we had a question about 2G, number 2. On that one, it says that Jenny, 16, worked as a waitress and earned $6,100 while going to high school. She put $4,050 in the savings account to be used for college. Mom and dad provide all of her support. And our question was, to meet the gross income test for dependency, a person's gross income for the year must be less than $4,050. The exemption amount. This applies to a qualifying relative, not a qualifying child. Okay, so this one, because Jenny is in school and age 16, she's a dependent on mom and dad's. So write yes or no on the top line if the child can be claimed as a dependent. The answer is yes. Okay, write yes or no on the bottom line if the child is required to file. And on the, let's see, on the 2A one, that she would be required to file. Okay. Because her income is, well, let me back up here, okay? Let's see here, because there's this kind of a gray area. She's not required to file, but she will file because chances are she has withholding, and she will have income that is greater than the standard deduction on New York State, okay? So basically what I'm saying is that, you know, it's kind of a mixed bag on this one. It's kind of situation by situation. Jenny being a college student, say that she works at Tim Hortons, she probably had tax withheld. She's going to want to file even if she's below that filing threshold for a dependent on her parents' return, okay? And she's definitely going to want to file on the state side. The reason being is, let me just go over here to my New York State considerations. That's that little one other book that you have in there. And if you take a look, whoops, hold on one second, I'm a little faster here. If you look at the standard deductions that's on the screen there, you can see that the filing threshold for somebody like that is pretty low, okay? So, you know, her income's greater than $3,100, she's going to have to file. And this is where we run into a lot of times with dependents where they'll have a nice federal refund because, you know, they still have the standard deduction, but on the state, they chances are owe money. The way things work on the withholding tables for New York State, you know, if your check per week is, say, $250 or less, they're not going to withhold any tax. You get to the end of the year, they pay tax, okay? That's why I advise a lot of my clients that have kids that work that are their dependents, that when they fill out that IT 2104, that's the sheet you get when you get a new job for withholding allowance, that you fill that out such that they automatically take $5 every time there's a paycheck, because like I said, they might not have a withholding on that, okay? All right, and let's see, we had another question on 2A. Okay, these were determine the correct filing status that would be most advantageous for each taxpayer in the following situations. It asked us to use the abbreviations that we have there. Okay, all right, and on 2A we were at number 6. Okay, Dave Adams is married, separated from his wife June in early May, and his son lived with him for the last 8 months in 2017. How does David file? Well, when we look at the phrase, the first thing that probably comes to mind is married filing separate. However, the most advantageous for him is going to be head of household. This is where we come into play with the things where he can be considered unmarried because they did not live together for more than half the year. It says it's there that he was separated from his wife June in early May, that's tough enough because we got to keep her names a month too. But because they were separated in early May and they did not live together after July 1st or for more than half the year, and then David has his son who lived with him more than half the year, so that would be a qualifying child of his. His most advantageous is going to be head of household. Okay. All right. Any other questions on the exercises? Okay. Like I said, I know we did a problem. Okay. I know we did a problem last week. We'll do a couple more this week, so we'll have on that. Okay. Any other questions on anything with the exercises or the quizzes? Any of the questions here? Okay. All right. And let me go back there and check. Okay, we're good there. Okay. All right. And one other thing we'll just take care of. We had a little question about the quick link getting to the W-2s. Okay. So if I have my, again, I'm going to go back to my Charlie Brown. Navigation-wise, there's a few different ways to get to the W-2, okay? Sometimes what will happen is if you look on the tree on the left, we can have it there. So there's really 3 ways to get it, okay? So the first way is if you go to line 7 where you know the wages or the W-2s would go, okay? We can go there and hold on one second here. Okay, so we can go in here, and if I go into that line, all right, I can go into the box. I can hit the little gray icon. It's lit up in yellow right now, but I can hit the little gray icon, or I can hit F9, all right, and that's where we have the links for all the different forms that would go into that. We'll talk about a lot of the different ones. So I can see right there, I got it lit up in blue right now. There's where I can get the W-2, okay? So I can get it there. Another way to do it is if I look at my tree on the left and I go down, I can see right here, I have a W-2, okay? All right, so if I click on that, it's lit up in blue. This Charlie Brown, oddly enough, works for Esther Gulia's tax service, okay? So we can find it in the tree on the left, or, and again, this is preference on how you like to navigate, okay? All right. We can go to add a form, and this has a list of all of our forms that are available in there, and where it says look for, right now it automatically filled in, but if I wanted to look for a W-2, I'd type W-2 in there, I'd hit enter, and it would bring up the W-2. I can either get a new one or go to one that's existing on there, okay? So that's really the way that we get around you know, as far as finding the W-2s on everything, okay? And again, when we're doing the problems, I'll try, you know, when we're doing specific worksheets, schedules, forms, whatever that may be, I'll try to make sure that I explain those as best as possible and highlight them so that the maneuvering. Like I said last week, get in there and don't be afraid to really play with it. If you break the, you know, for some of you, I've been doing it, but if you break the software, I'll download a new version for you. Don't worry, okay? You really can't break it. We'll be fine there, all right? Okay. All right, okay. Again, in the exercises, if you want to type in there, anybody else have anything as far as Chapter 2 or Chapter 3 that we're worrying about? Like I said, a lot of them are pretty straightforward. You know, as far as the information that we would need to do, really that we're just looking for the information, you know, as far as learning the 1040, learning terminology. You know, that's why we start out the way we do and emphasize the filing status, filing thresholds, things like that. That's really the base for everything. Each thing we do each week is going to add to this, but that's really where we just kind of, you know, make sure that we have that. Okay. All right. Okay. That being said, we're going to go ahead. Whoop, we got another question here. 2A5. Okay. All right, 2A number 5. Wanda Hines is single. Her niece lived with her all year. Wanda provided all the support for the household. Okay, so 2A number 5, that would be head of household. Okay, granted, it's not a qualifying child, but it is a qualifying relative that she can claim. You know, she provided all the support, and she's permitted to claim her niece, and nobody else is claiming her niece. Then she can do head of household as long as she resided with her. So our test that we would have for putting somebody on there as a qualifying child or relative is met. Okay. All right. Okay. All right. All right. So we're going to head into chapter 3. So if you got your books, or I'm going to have it up on the screen here. So we'll head into chapter 3. We're going to talk about, earned income, okay? And let's see here. 1 second. Oops. I'm sorry, we're going to start chapter 4. Chapter 3 you guys did, okay? All right. Okay, we're going to start with 4. There we go. Okay. So we talked about earned income. Most of that earned income comes off of things. It's W-2s, all the different things that we have there. Okay. So we're going to get into, all right. Okay. I'm still getting some things in the thing. Does anybody else have any questions about any of the exercises? Okay. Before I start chapter 4. If you could type them in the chat, that would be great. Okay. All right. So if you can get those in there, that would be great. All right. So we had one more question about from 2F number 5. Let me find the exercise so we can have it up here. All right. 2F number 5, a child that was born in the United States but lived only for 1 hour. Okay, that is, you know, that one meets the test for citizenship, residence, qualifications. That is a dependent. Yes, granted, it's a sad situation that somebody only lived for 1 hour, but that would be a qualifying child that would be a dependent on somebody's return. Okay. All right, so let's head into chapter 4, okay? So we're going to head into chapter 4, and this section, as we talked about, was going to be on unearned income. If we remember from chapter 3, we did earned income. We talked about a lot of things as far as the W-2s, things like that. That's all earned income. As I talked about at the outside of the outset of the chapter, it's where we have made money. Okay, we have earned it from work or services or whatever that may be. Okay, what we're going to go in today is unearned income. Okay, so what we're going to talk about, our objectives in this one, we're going to talk about how to recognize the types of unearned income. We're going to talk about the 1099 INT and DIV. Those are interest and dividends. We'll see how they're reported there. I'm going to send out some sheets to you. I have some that I created for my in-class classroom sessions that I'll send to you as PDFs that are kind of some other examples of how you might see interest and dividends. We'll talk about those a little bit so that you can see those. On the break, I might try to scan them in and see if I can get them up here for us so that we can see that. We'll talk about a Schedule B. That's where our interest and dividends will be reported. Some savings withdrawals. You know, right now, interest rates are so low, we don't see a lot of interest on things, especially if it's below a certain amount. We may not have it reported to us, nor would we have to report it on the tax return. We'll talk about how state refunds are handled. We'll talk a little bit about alimony. K1, again, I have an example I'll put up. K1 is just a fancy name for a W-2 that may come from a corporation, a partnership, an estate. If you're the beneficiary on somebody's estate, you might get a K-1, but really it's just the equivalent of a W-2 for one of those entities, like a trust, an estate, S-corporation, partnership, things like that. Okay, we'll talk about unemployment. We'll start to get into a little bit about miscellaneous income. This one gets a little gray sometimes because the miscellaneous income, that 1099 miscellaneous, is a catch-all with a lot of things. There are some earned income on a 1099 miscellaneous. We'll talk about that. We'll talk about gambling winnings. I did not see from anybody in the class that on Tuesday any of you won the Mega Millions, unless I have a student in South Carolina that I'm not aware of. But we'll talk about how to handle the gambling winnings. And we'll talk about line 21, which is on the 2017 1040. That is basically the catch-all for anything that doesn't show up on any other line for income on the 1040. Okay? All right, so we're going to start out with interest and dividends. Interest income, again, money received for money loaned or deposited, okay? Or interest might be on different things like bonds or whatever it may be, but it's that income that you have. It is unearned income, all right? It's going to be reported on a 1099 INT or whatever it may be on there. Some tax exempt dividends and interest might be on the 1099 DIV. And again, I think on the break I'll try to scan that up so I make myself a little bit more clear. But a lot of times if it's less than $10, it will not be reported. A lot of people will come in to do the return and they'll say, I didn't get anything from the bank. And I said, did you earn less than $10? The bank won't send it out. A lot of credit unions, however, there's one in the area that I've gotten 1099 INTs for 3 cents because somebody earned 3 cents or less on their savings account. When you type that in with rounding, it doesn't do anything more than create a 0, okay? But we want to make sure that we record, even if it's less than $10 of interest, that we received. You don't have to, but if there's a statement issued that's been given to the IRS and a 1099 INT, make sure that you put it in there, okay? The 1099 INT also will show interest on savings bonds. We're going to talk about how that's treated and may have some things for penalties for early withdrawal. And sometimes people, depending on how their interest is reported to them, knowing that it may be a large sum, especially if they have an investment that has a lot of bonds in it, they may have the tax withheld there. And you might end up paying foreign tax. And we'll talk about how that's handled, okay? As I talked about, right here in the bottom of 4.4, there are a bunch of different examples of things that would be interest. Okay, the one I want to point out is the bottom bullet one. This is one sometimes people ask. Helped an individual the other day. She has a rental and she has decided that the tenant has approached her and she is going to sell the rental to the tenant and hold the mortgage, okay? So in essence, she's become a bank and she's going to hold the mortgage for the individual and she will collect the mortgage payments, all right? As far as selling the rental, we'll talk about that later, but just like a bank would, that interest is income for her. She will have to report, okay, on the Schedule B, and I'll show you where that's at. On the top of it, she has to report that interest as income, all right? She does not have to report the entire amount of the interest she's going to receive, just the interest she receives from the payments. So if she gets 12 payments from her tenant when he's buying the house from her and she's holding the mortgage, she just shows that interest income, okay? And say she holds it for 10 years, she'll have interest income for 10 years, okay? So make sure that you understand that that is interest also. On our 1040, you'll see that there's a line. There's a little part that's blue there. There is a taxable interest and tax exempt show up there on line 8, and line 9 is the dividends and qualified dividends, okay? If there's tax withheld, goes right to our line 64. And again, we're talking about the 2017 return. It would, I'm not sure what schedule it would flow on to in the 10/8/2018. Haven't quite figured that out yet on all the logistics, but as I figure it out, I will make sure I bring it to you, okay? Now, down at the bottom talks about a little help box, and these are great because they're kind of little reminders and great bullet points. U.S. Treasury obligations, okay? So savings bonds, bills, notes are exempt from state and local income taxes, okay? Municipal bonds are generally issued by state and local governments to fund capital improvement projects, all right? The federal government does not tax municipal bond interest. However, on the state, it may be taxable, okay? And down here, there's a great little table that talks about interest. So if you look right there in the middle of the page, all right, we have a great little table here, and this is a great one to know where it's at. So if you're an individual that has started putting little tabs and Post-its on your workbook so that you can refer back to it, this would be a great page to mark, because this talks about the different interests that might show up on that 1099 INT and whether it is taxable on the federal and taxable on the state, okay? As we go down in the middle, we see municipal bonds, all right? It says no on the federal and no on the state, but there's an asterisk, okay? What that means is if my investments, say that I have a bond fund that is buying bonds that are being sold by schools to raise money to build new gymnasiums, okay? If all of, and I'm a resident of New York, if all of those schools and those bonds are in the state of New York, then that is not taxable on New York, okay? But I am a resident of New York, and the fund is buying bonds in Ohio, Pennsylvania, and New York. Only that interest that is from New York is tax-free on the New York. I have to pay tax on the state bond interest that I may get from Ohio and Pennsylvania, okay? So that's an important one to make sure that you understand that, you know, there's an exception there on those, okay? A lot of times, you know, it used to be that the distributors of the bond things did not show the interest, you know, where it was broken down, and you had to go digging for it. And the state of New York caught on to people that were claiming exempt municipal bond interest, but they were for states other than New York. And they were getting the love letters from New York State. We started seeing them 2 years ago. When they were filing 16, we would have been in the 16 tax year for 2013. So they were 3 years behind on catching up on this, okay? All right, so we have interest. And like I said, that's a great little table to keep track of, okay? We have dividends. Again, dividends are the distribution of money, stock, or other property paid to a taxpayer by a corporation, partnership, estate, or a trust, okay? They can be made in the form of cash payments. A lot of people that have life insurance policies that may be through something that is mutual, they would maybe get dividends and they get a little check at the end of each year. But sometimes dividends not necessarily are going to come to you in the form of cash, okay? They may just be reinvested. And what happens with dividends is they are reported as ordinary and dividends, or excuse me, it's qualified. The ordinary dividends, that's just ordinary income. You pay tax on it. You may not have received a check to put in your pocket, but you do pay tax on it. Qualified dividends, they are taxable at the net capital gain rate, okay? Basically, with qualified dividends, they're not added into our taxable income, but they may be depending on your income and the amount of qualified dividends along with capital gain distributions. Basically, what you're doing is you're paying a little bit of tax as you go along on those dividends and capital gains, and that will affect your basis later if you choose to sell the stock. All right. They basically have you pay stock in portions as you go along while you own that stock. And then at the end, when you sell it, there may not be as great a capital gain when you sell your stock for a profit, or it may affect a loss, whatever way. And when we do the chapter 8 on capital gains, we'll talk a little bit more about that. Okay. Now, this other one that shows up quite a bit is foreign tax paid. Believe it or not, if you pay tax in a foreign country, the one I see most often is, I believe, Fidelity, Wells Fargo, a couple of the other brokerage houses have a lot of this fund called Lord Abbott. And obviously Lord Abbott sounds like he's in England. And if you have inside there, because of your investment, that you help that fund pay tax, you get a foreign tax paid credit. Okay. I'll show you when we do a problem how that goes in there to make sure that you record it correctly. It is a credit. So we'll talk about it too a little bit when we do the next chapter, when we talk about some of the, or excuse me, chapter 6, when we do some of the non-refundable credits there. Okay. This is a Schedule B. You know, for a lot of my clients, I have one gentleman that is 97 years old, comes in with me every year and we do his taxes. And he comes in, and rather than have his stack of pages, because his retirement is based off investments in stocks and things and CDs, he comes in and he has a nice little list. He has me print out a Schedule B form the previous year, and I give him a couple copies, and he comes in with it outlined here. This is where it is recorded. This is where it will show up on there. Things will be a little bit different when we get into the software as how we handle it, but this is where interest and dividends show up, okay? And he's great about it. Being 97 years old, he inherited some AT&T stock, and the dividends that's funding his retirement is outstanding, okay? I have to believe that some of those shares were probably given to his ancestors by Alexander Graham Bell by the amount of dividends that he has on his income, okay? Down at the bottom, part 3, foreign accounts and trust, all right? Don't worry about that, okay? That's kind of some of the advanced stuff. Just know the one thing down there, if somebody talks to you and you end up with a return where, say that you have somebody that is a U.S. citizen, but they are married to somebody from Canada, living in Canada, they still have to file a return. But if they have an investment account and or bank accounts in Canada in their name, they would have to do, and you see these little letters in there called FBAR, the F-bar. They have to disclose that. That's some of the things. Canada is not really an offshore thing like you would think of with the Cayman Islands, but if somebody has something like that, they have to disclose that. Okay. All right, so you got a few exercises here that you'll do. Just kind of working on getting things off of a 1099 INT and the 1099 DIV, the interest and dividend 1099s, and just making sure they get into the correct portion of our Schedule B. And again, I'm going to pick this part a little bit more when we get into the problems that we're going to do as an example. All right, and there's our friend the Boyds, okay? Taxable refunds, okay? If you receive a state tax, or state or local, if the state has local taxes, and you receive a refund for 2016, you would record that on your 2017 tax return if you itemize, okay? If you do not itemize, then we will not disclose that, okay? All right, so that's where you would make sure on those that you have those different that you have that. It talks in there about the 1099G, okay? New York has decided if you, and again, we'll talk about a little bit later when we do some unemployment, but New York has decided that if they are not going to mail, or excuse me, not going to mail these out automatically. You either have to go online to get them or request that a copy be mailed to you, okay? So a lot of times for our clients, and that's where when you meet with somebody the first time, you need to make sure that you see their previous year's return. We have to determine if their state refund is going to be taxable or not, okay? All right, and there is a 1099G. Again, they look like this, but you retrieve them online. Same thing with unemployment. It goes on the 1099G. You can see box 1 there on this form. Unemployment, it'll have tax and, or excuse me, federal tax and state tax withheld. But again, they have to get this. Even if you have somebody that's unemployed, that does their unemployment on the phone because they do not have a computer to go online, they won't mail it to them either. Okay, they will have you, you know, call to have a copy mailed. And during tax season, do not send them to the unemployment office. They get a little grumpy and they won't print them out for everybody. Okay. All right. Okay. And again, if we have an individual that does not itemize, okay, so they did not itemize the previous year, they do not have to claim that state or local income tax refund, okay? So they don't have to claim it. Now, little caveat, and it'll come up in problems every once in a while, okay? If I have a family that say they get $1,000 refund on the state side, but they have 2 children, okay? So they have 2 children on their tax return from the previous year. Not all of that refund is taxable, okay? A prime example is that refundable child credit on the state, they get to subtract that out. And that credit is $330 per child. So basically what I'm saying is you take the 1,000, we subtract the 660, you get 340. That is the taxable portion of their state refund, okay? You know, somebody's state refund, same example, you have a family with 2 children, they did itemize, but their state refund was $500, then I do not have to claim any refund because my 2 credits for the kids, the 660 was greater than my state refund, and we see that a lot, okay? So that is one thing that you will do on that, all right? Alimony, okay? All right. This is one that's become very interesting because of the change from 2017 to 2018's tax laws. Alimony is payment for a spouse or former spouse under a divorce or separation instrument. Okay. This is where they're paying. Sometimes New York will call this maintenance. All right. And it's maintenance in the sense that it is equal to alimony. Maintenance that is for the maintenance as we think the traditional word of the home is not alimony or income, okay? So basically what I'm saying is alimony income, so if somebody is paid alimony of $1,000 a month, they have to claim $12,000 of income, okay? I do have a client that I do. She receives $80,000 a year in alimony because of her divorce. Okay, so she has $80,000 of income that she claims, and every year we have to set up estimated payments because obviously that money's coming to her not in the form of a W-2. It's just a check that's paid to her, and she has no tax withheld, so she has to pay the tax quarterly so that she doesn't have a huge bill at the end of the year. 2018, alimony is no longer taxable income, and no longer what we'll talk about later is adjustments to income. So that means that people that client that receives $80,000, her income would still be taxable because her divorce was finalized prior to the change in the law. Okay, so basically what I'm saying is that divorces going forward will not be taxable for alimony, but anybody's divorce that's finalized prior to this tax year, that is grandfathered in. It's still on the form for 18. They still have to pay tax on that alimony, okay? So the reason I'm saying things may be interesting is there are a lot of people that are working on restructuring, I guess would be a good word for it, their divorce decree. And if it's something that can be stated that would be in effect for after the tax laws changed, then their alimony may no longer be taxable income, nor may the payee be able to deduct it, okay? Great little table here, talks about the things that are and are not alimony, okay? So make sure that you just understand. Biggest one to understand is that child support is not alimony, okay? The person that pays it does not get to deduct it, and the person that receives it does not get does not have to claim it as income. Okay. All right. K1. Again, we'll get into this a little bit more later. when we talk a little bit about businesses and stuff like that. And when we talk about Schedule E's much later in Chapter 15, we'll talk about a little more how the K-1's generated. And again, on the break here in a few moments, I'm going to try to scan in what I handed out and see if I can bring that up so I can talk to you a little bit more about what a K-1 looks like and how it works, okay? But just know that it's reported as income. It's unearned income, and it shows right there that you can see that it goes on line 17, okay? And again, K-1s may come from an estate and trust too. It's not just necessarily from a business, all right? Unemployment income, yes, it is taxable income, but it is unearned income, okay? A lot of times I will have people come to me and they will have from the previous year, they might be a little lower on the income so that they're making $15,000 or whatever, and they have an earned income credit that we're going to talk about in the next chapter, but they had a nice big refund. Well, they lost their job, they were out of work, and their unemployment paid them, and they got the full 26 weeks maximum, so they may have $10,000 or $11,000 worth of unemployment income. That is not earned income, okay? So that does not get the earned income credit. Unemployment is unearned income, and you must report it. A lot of times people will not try because they are unemployed and the budget's tight. They won't take any federal or state tax out of it. I advise against that for people because then all of a sudden they're going to have a big tax bill at the end of the year because that is taxable income and the full amount that you receive is taxable, okay? All right, so just make sure when you have somebody that they make sure that they're taking tax out of it. All right, other income. Basically, anything that we can't find on our 1040 in line 1 through 20, spot for it or specific line for it, as it once is reported, we hit line 21, where we'll have a bunch of different other incomes. I don't think we run across to many people here that residents of Alaska that get that. Does talk about court awarded damages. Again, make sure you understand, taxable income is interest, lost wages, business damages, emotional stress, and attorney fees that you are paid, okay? If it's 444, 4444 income, all right, that is non-taxable, all right, because that is personal or physical injury, all right? Employee awards, we probably talked about that in the last chapter. The boss, I guess it's a Monday night game, so you might take it, offers you his suite and parking and everything else that comes with tickets to the Bills game. If that is greater than a value that the $50, then you have to claim that as income. So it would show up on your W-2 and or your pay stub that you pay tax on what he gave you. That is a very recent thing that people are doing. I should say employers are doing because the IRS in the state of New York have kind of cracked down and saying that that really is taxable income. Hobby income, if I'm building birdhouses and I'm not in it for profit, but I'm making some money, all right, I can't take any expenses, but I have to declare the income, okay? Illegal activities, all right? So I guess seeing that our laws have changed in Canada to the north, and I understand we had our first arrest for somebody trying to bring some contraband back across the border, but if somebody is in any illegal activities, that's where they would put that income. So if somebody wants to claim the fact that they are illegally selling something, they could put that income on line 21. Again, we talked about prizes and awards with the things from the employees that may be there. Another example is for those of you that like to partake in calling in and trying to win concert tickets on the radio, that's another one, okay? You would have on those prizes and awards that you win, the radio station will probably send you a little 1099 that says, hey, you won tickets to see Trans-Siberian Orchestra, and they're valued at $100 each, so you pay tax on that $200. The last point there is rents from personal property. If I am renting a property, say I live in a double and the other half is my brother, and I'm renting below market value, that's where I declare that income. because if I am not getting market value where I am in it for profit, I cannot take expenses. It does not go on a Schedule E, and I have to declare that as income, okay? We're going to talk a little bit more in detail here about canceled debts, gambling winnings, and the other things that are on a 1099 miscellaneous, okay? Canceled debt. This is one a lot of people don't understand and why they get these or how these work. Okay. Cancellation of debt is basically, the best example is I have a MasterCard that I owe $5,000 on. MasterCard calls me and says, hey, we'd take $3,000. And I say, okay, great, I can do that. I pay the $3,000 and they forgive me $2,000 in debt. That is a canceled debt, okay? So that forgiveness of debt, that $2,000 becomes taxable income to me, all right? So a lot of times people will get these and they even show up 2 years later from when they canceled or settled because the way the books work for whoever canceled the debt in writing that off. So that is cancellation of debt, okay? Now, it's going to show up on a 1099-C, and it'll be categorized or whatever it may be. There is one thing that you can do, and I believe it talks about it in here in the chapter, but if they have a cancellation of debt, as it says here, you can do Form 982. 982, and when we get into one of the problems, I'll show you it in the software, the tax software. 982, basically what it is it says, well, yes, I had $2,000 in cancellation of debt, but the reason I did is I'm in bankruptcy or I'm insolvent, okay? What insolvency means is that if I take everything that I own, okay, even my car and my, stamp collection and my baseball cards or whatever else, anything that is of a value that I own, and what I owe is greater than what I own, then I am insolvent, okay? And includes the house, retirement accounts, everything like that, okay? We have a little worksheet on the website that, again, I'll show you when we do one of the problems. That is a little asset and liability. They call it worksheet, but basically it is saying, do you owe more than you own? Then you are insolvent. Then basically what I can do on the tax return is get rid of that cancellation of debt, okay? So that's the thing we'll talk about when we do the problems. But just know that it is taxable, okay? Gambling winnings are taxable income, okay? So if I have income that I've won, and most of the time they will issue a little W-2G if it's over $1,200, the casinos will print out the little thing. Or if you have winnings, again, this is the line. If you won the Mega Millions or you're planning on winning the Powerball very soon, this is the line that you would put this on, okay? You can offset your winnings by losses, and the losses would go on the Schedule A, okay? So around the casino, a lot of times it said, oh, don't worry about it. You had losses equal to it. It's not taxable. That is not true, okay? If I have winnings, I must report all of the winnings. I can put losses against it, but I have to itemize, all right? And if I don't itemize, then I pay tax on that full amount, all right? So make sure that you understand that. A lot of people have this notion that just because they had losses equal to their winnings, they don't have to report the winnings, that it's not taxable. You see a ton of letters for people that have not reported gambling winnings, okay? All right. The other thing is, a lot of times people that have the little cards, the players' cards, I believe they call them, at the casinos, they can get these win-loss statements, all right? It says there, a casino win-loss statement often provides only a player's net win or losses. It does not show the total of all gambling winnings and is not sufficient for tax reporting. Basically, if you're somebody that's a regular gambler, you have to show, I went to the casino with $200 in my pocket, I won $400, but I lost $600, okay? So you have to have a journal. You can't just do these win-loss statements, okay? Used to be that you could use those, but they've kind of cracked down on those. I had a client that had pretty hefty winnings at one of the casinos. They have little kiosks that they can go to. I sent him to the casino to get his win-loss statement. He returned a few days later to finish up his tax return. And he says, well, that wasn't a good idea. I want another $7,500 while I was up there getting my win-loss statement. So he didn't have taxes for the next year. All right. And again, losses. Those losses can go on there. All right. And they will go on the return on the Schedule A. And we'll talk about that when we get into itemized deductions. Okay. All right. 1099 miscellaneous. Again, this is kind of a catch-all. All right. This 1099 miscellaneous is a document that has a lot of squares for a lot of different things. Box 1 talks about rents. If I have somebody that maybe has housing where they rent to somebody that is rent subsidized, they might get one of these from the city or the county. If you get royalties off of something, you wrote a book. Other income is that, and this is truly where this is kind of originated, is other income. This is not like box 7 where it's non-employee compensation. That could be earned income. Okay, if I work for somebody, this one shows Z Builders, and it shows that there's $5,500 of non-employee. That means that they paid me as a drywaller, as you can see there, to work for Z Builders, but I'm not an employee. I was just a independent contractor they hired to help finish a job. So they gave me $5,500. That is earned income, okay, that non-employee compensation. And it actually goes on to a Schedule C or CEZ, as it talks about here, okay? We just want to kind of make you aware of it because we're talking about 1099 miscellaneous. When we get in Chapter 13 and 14, we'll talk a little bit more about the Schedule C and CEZ, okay? So it's just kind of for your knowledge right there, okay? As far as that defines what non-employee compensation is there. That box that says other income, the box 3, that really is a box where you would see, like I was saying about winning tickets for the concert. Okay. All right. And again, read through this. Don't get hung up on the Schedule CEZ and the self-employment tax. We're going to get into that much later when we do the business ones. It's just kind of an introduction so that you understand where it goes when we're doing some exercises right now. Okay. There's income that can be both taxable and non-taxable. These are non-taxable. Inheritances. Most of the time when we think of inheritances, you go down there for insurance proceeds or life insurance. Those are non-taxable. They don't show up on a tax return. We talked about child support. That is not taxable income. Okay. You don't have to pay tax if you had a federal tax refund. All right. Medical insurance proceeds, rebates, veterans, and benefits. So if you have somebody that's a veteran, especially from active duty, none of that shows up on a tax return. Neither does workers' comp. Okay, those are not on there either. All right. All right. So we've been going at it for a little bit. That's the end of Chapter 4. Okay. So what I'm going to do is we're going to take about we'll take about 5 minutes, okay? So if you need to stretch your legs, use the bathroom, fill up your coffee, whatever it may be. While we're on break here, I am going to go try to scan in those forms that I was talking about so that I can show those to you. All right, so we'll see everybody in about 5 minutes. All right. So we're back at it. I did have a chance on the break there to get some things scanned in. So I just want to kind of show you those real quick since we talked about them. We were talking about the K1. Okay. This is what a K1 looks like. This one came from a partnership. Somebody owns some, was a percentage partner. As you can see, very minuscule. A lot of times, a lot of these are very, very minimal, less than 1%. Ownership, but you can see there's boxes like you would see on a W-2. Most of the time, the only thing that we're ever really worried about is the boxes that talk about things that we might report. So really, we're kind of looking at these boxes right up here. Has some things about short-term, things like that. Things that will, when we get to the Schedule B in the software. I'll kind of show you. That'll make a lot more sense, but this is where most of those are. When we do get later to chapter 3, or excuse me, the chapter about Schedule E, we'll talk a little bit more about what some of these other boxes, but right now we see some things that look very familiar. We have some income, business income. We have some interest, some dividends, some royalties, long-term capital gains. So those are things that we would report off the K1. Okay, so that's why that was brought up at that point. All right. The other thing that I scanned in, again, I'll email everybody this as a PDF so that they have it. I apologize that this one's going the wrong direction, but basically what I want you to get out of this is if you look here, and again, you'll be able to print this out so you're not crooking your neck like I am right now to look at it. But this little box right here, as opposed to that 1099 INT that we're used to seeing, this is a lot of times where we'll see, or excuse me, the 1099 DIV, this is what we'll see, okay? You can see that there's the boxes. They're numbered just like it would be on a DIV, but it's in a little different format than we see in our textbook and might see in our workbook practice problems. But we have those dividends. Again, we'll show you how those go in there. This one had some exempt interest dividends. Again, we have to be careful on those and make sure with those with the state that that's not where those are taken, okay? So that's where that's this. You'll see this, and we'll talk about this later. Right down here, this other red box that I'm drawing on here, that one is something that we'll see later. These are capital gains where somebody sold stock, and we'll talk about that. So you'll see that on those sheets that I handed out there, okay? On the next page here, we get into this, and you know, there's a lot of different interest, I guess, that comes up that we talk about. But again, the reason I wanted to show you this one, it comes from somebody's investment or brokerage account that they have, or might be the way their retirement is. But we can see the 1099 INT here. So it doesn't look like we saw it in the textbook, but it does come in this, and these are pages that would come back on somebody's securities brokerage account investment, okay? So they would be reported that way. Again, numbered the same way they are on that 1099 INT, it's just a little bit different format that we would see, okay? All right. That one's for capital gains. I'm going to send that to you since later, okay? This is the one I was talking about as far as tax-exempt interest dividends. And again, I apologize that it's sideways, but this one, what I want you to just kind of notice is right here, it talks about the description of it, but that you can see all these are listed as New York, okay? So that would be the case that these may be municipal bonds of some kind, and the reason they're stating that it's New York State is so that you know that if you are a New York State resident filing a tax return, that it is also exempt on your state side. If that state column, sometimes they'll say multi or various, that means you have to go find out how much of it is New York and how much of it is other states or other areas that municipal bonds like that, and that you would have to determine how much it is. If you have to do that, what I did is, this is one of the ones I had from last year, because as soon as I have a client that comes in with this, I'll find these tables and print them out. So if you look at this first column here, okay, we have it on there. It's a Fidelity Intermediate Municipal Income Fund that they have. So they have a bunch of municipal bonds that they put together that people may invest in, okay? And if I go down here to the bottom of my red box, I can see that only 6.71% of that holdings, okay, is for New York. Well, basically what that's saying is that the other, you know, give or take 93, 94% is taxable in New York. You can only exclude 6.71% because that's all that is New York municipal bonds, okay? So that's where these, and that's where I talked about, you know, have to do a little bit of, sometimes you have to do a little bit of it, extra work to kind of get in there and find out if that's all taxable, okay? So again, I'll send those out with the homework and the link to today's lecture. Okay. All right. Okay. Just so we have a little interaction, know anybody's alive out there, if you have any questions right now about Chapter 4, anything we covered, you can either unmute your mic and I can hear your voice, or if you want to type it in the chat. So anything that's come up about what we talked about unearned income on the Chapter 4, go ahead and ask away there if anybody wants any clarification. And just so you know, if you want to unmute, you can go down to, if you take your mouse all the way down to the bottom left, there is a little microphone there. And again, I have it set up that since I'm the host for the meeting, that I mute everybody when they come in. So if you have any questions and you don't want to unmute, like I said, there's a little microphone way down in the lower left box when you get your mouse over it that says, probably has a little red line through your microphone, or you can type it in the chat. Anybody? Okay. Everybody a second here. Some people might just still be getting back and get situated. All right. And like I said, don't be afraid to ask questions as we go along. I'll try to answer them best I can. Like I said, there's a lot of times that I will copy out the chat. I copy and print it so that I have record of it, questions and things like that. And if I missed a question, I do apologize, but I'll try to get back to you on it. Okay. All right. Going once, going twice. All right. Okay. So we're going to head to Chapter 5. All right. And Chapter 5, we're going to start to get into credits. Okay. This is refundable credits. All right. And the way I want everybody to remember this, and this is the way I was taught by Tiffany Fabian many, many years ago when I took the class, is that refundable credits, I want you to think of those like the Energizer Bunny. All right? And the bunny just keeps going on and on and on and on. So basically, refundable credits have no end until you get them all in your refund. Okay? We're going to talk about non-refundable credits. All right? They are the Pac-Mans, and I'm probably dating myself, but if you think of Pac-Man, eats up all the little dots, and then once they're gone, he's done. So that's basically a non-refundable credit, eats up your tax bill. Once the tax bill's gone, or the tax that you owe, it's done. You don't get it in your refund. It just wipes out your tax bill, okay? And we'll see how those work, but we're going to talk about that, okay? So what we're going to do here is we're going to talk about refundable credits, okay? And again, I want you to remember, refundable credits, Energizer Bunny. They go on and on and on forever. Non-refundable, Pac-Man, they eat up the tax, okay? Now, we're going to start out in this chapter and we're going to talk about tax deductions and tax credits, okay? There's a difference, all right? We'll talk about that. We're going to get a little bit of an understanding of the difference between non-refundable and refundable credits. We're going to talk about the earned income credit, okay? And we've already discussed what earned income is, thus the name earned income credit. It is not the unearned income and earned income credit. It is not just the income credit. It is the earned income credit, okay? Additional child tax credit. We're going to start a little bit touching on the base of American Opportunity. The premium tax credit, again, as it says, we're going to cover that more in 16. We'll do a little touch there. We've talked a little bit about excess Social Security, and this will probably be the only time you will ever hear of the credit for tax on undistributed capital gains, okay? Very rarely ever are you going to see this one, okay? Most of the time, capital gains will be taxed, but there is a credit on tax for undistributed capital gains, okay? And not really going to spend a lot of time on it because there's other things I'd like to do with you while I have you this morning. So health coverage tax credit, we'll talk about that, okay? All right, great little section here to understand how deductions and credits and non-refundable and refundable credits work, okay? We got a great example that we're going to go through. So the first thing we're going to have is John and Jackie are two unmarried taxpayers. They file single. So they may know each other, but they're not married filing separate, anything like that. They're just two separate people, okay? John makes $10,000. Jackie makes $100,000, okay? That is their taxable income, and we see their tax rate of 10 and 20% over there. So they're going to pay $1,000 and $20,000, okay? So that's kind of our baseline. All right, the first thing we're going to talk about is a deduction, okay? Deduction there, John got a tax deduction, okay? It could be an adjustment to income or a deduction, all right? That reduces his taxable income and his tax bill. Again, we're based on 10%, so he has a deduction of $50, okay? Same deduction, $500 for Jackie, okay? It shows her taxable income or tax due. That deduction saved her $100, okay? So deductions are really a proportional thing or a percentage thing, and they are not a dollar for dollar, okay? So deductions have to do with the income, all right? So deductions are going to reduce income, all right? Okay? So that's where they relate to. So the deduction is going to directly affect income, and our total savings will only be a portion. It's not dollar for dollar, okay? Again, I go back, a lot of times people come in and said, well, you know, I spent $1,000 on a new furnace. Isn't that a deduction? Well, yes, it is, okay? Why is it not in my refund? Because it is a credit or deduction that's going to reduce your taxable income, and you may get a portion of that as a savings, not the whole amount, okay? All right, so we're going to go back to our same scenario. We got John and Jackie. We see their income there, okay? This example, however, instead of it doing a deduction, we're doing a credit, okay? So John owes $1,000 in tax due. Jackie has $20,000, all right? They each get a $500 credit. That means they each get $500 in savings because a credit is coming off their tax and is a dollar for dollar reduction of what they owe, okay? All right, so again, a deduction lowers the income before we calculate the tax. A credit eats up the tax bill, and that is where our savings is, okay? So make sure we understand, generally a tax credit is a dollar for dollar, and a deduction is a portion, okay? So that's the difference on those two, all right? Now, we're going to go to the difference between non-refundable and refundable taxes, okay? So we've done deductions and credits. Now we're going to break down credit a little farther. A non-refundable credit is a credit is more than the total tax due. It reduces the tax to zero, but we don't get the extra, okay? Okay, that's the Pac-Man. It ate all the little dots. Refundable credit, that's our Energizer Bunny. If we reduce our tax bill to zero, we still get the excess as part of our refund, okay? All right, so we have our example here again. We have John and Jackie. We did a little bit difference on John's income though, okay, and their tax rate. On this case, a non-refundable credit, okay? So we had taxable income for John. His tax due is $800, okay, because of the 10%. He has a non-refundable credit of $1,000, all right? Now, that $1,000 wipes out his tax bill, but because it's non-refundable, I'm only saving $800. I don't get the excess. In the case of Jackie, that credit's a little bit more beneficial because she gets to use the whole amount, okay? All right, so she gets the full $1,000 as a reduction of her tax bill or tax due. All right, okay. Now we're going to go a little farther. Got our same example, John making $8,000, Jackie $100 with their tax at 10 and 20%. Now we look at it, we have a refundable credit, okay? We have a refundable credit. So in this case, John had that $1,000 refundable. It wiped out his tax and left him $200 that he's going to get in his refund. In Jackie's case, because her tax due was greater than the refundable credit of $1,000, it just lowers her tax paid. Okay, it's not going to go to her in her refund. So you can see, that's why I say refundable credit, if it's greater than your tax bill, it's the Energizer Bunny. It goes on and on and on. Okay, and again, credits are dollar for dollar. Now, earned income credit. Okay, and I can't stress enough that it is an earned income credit. Okay, only a credit for earned income, and it is a refundable credit. This credit, and I'm going to emphasize this a lot as we go through it, is basically a credit that is one of the biggest areas of fraud in tax returns. All right, it is a credit based on an individual's earned income and their filing status, and the number of, and it may also include the number of dependents or qualifying, or I should say qualifying children or qualifying relatives that they have on as dependents on their return. Okay, as it says here, it's a credit for people who work and have earned income that is less than $53,930. Okay, if I am married filing joint and I have 3 kids, my earned income credit is $3. Okay, if I am single and I'm making $1,000, my earned income credit probably is 0. Okay, the way earned income credit works is it starts at one level. Okay, kind of climbs up. It is not a bell curve. There is a plateau. All right, if I'm an individual and I am a single parent, had a household with 3 kids, my earned income credit at roughly about $13,000 to about $20,000 is identical. So that's why I say there's a plateau. So whether I make $13,000 or $20,000, my earned income credit for my household with 3 qualifying children on it is the same. Okay, so the credit doesn't keep climbing up and up and up and up and then go down. But after that plateau, it drops off pretty fast based on your household's income. Okay, so that's the way the earned income credit works. Now, this is a great little thing here that says earned income credit in a nutshell. These are the rules for everybody. There is no gray here. Just as the page is, it is black and white. All right, so it talks about the income thresholds for the adjusted gross income. And again, that's not taxable income, that's their gross income. All right, the individual must have a social security number, okay, by the due date of the return. Your filing status cannot be married filing separate. Probably one of the first times we really see the damage of doing married filing separate. All right, so you cannot file married filing separate, claiming the kids, and expect to get the earned income credit. All right, you must be a U.S. citizen or resident alien all year. You can't be filing anything with foreign income on a 2555. All right, your investment income must be 3450 or below. Okay, all right, so your investment income must be 3450 or below. We've talked about unearned income with our dividends and such. The individual that's 97 years old that I talked about, his investment income is well above that. Investment income can also include investment property. So if I live in a double, okay, and I'm a single parent with 3 kids and I live in one half, and I rent the other half out to help ends meet, and that net profit from my rental is greater than $3,450, then even though I have a household income that would qualify me for the EIC, I do not get it because I have investment income over $3,450. Okay? Everybody understand the way that works? You must have earned income. I can't stress that enough. It is earned income. Okay? And that, like I said, that rental income there, that investment, that unearned income of $3,450 or more would negate it. Okay? Part B for the qualifying child, they must meet the relationship, age, residency, and joint return test. So the qualifying child test. Okay? The child cannot be used by more than one person to claim EIC. All right? So I can't have them in more than one house to try, or I can't have 2 people living together trying to figure out a way to put the child on both their returns to get income credit. It just doesn't work that way, okay? And it can't be a qualifying child of another, okay? You can't be. So we have to make sure on that. One thing I want to kind of go through, a lot of times people with the ages, I'm just going to interject this here real quick, okay? We're going to talk about some non-refundable credits next class, but first threshold usually is 13 years old. That is for the child care or dependent care credit, okay? So if you have a child in daycare so that you can work, 13 years old, okay? Under 17, child tax credit, okay? So under 17, child tax credit. Under 19, earned income credit, okay? Under 19, earned income credit. Under 24, earned income credit if they are in college, okay? So those are some ages to keep in mind. A lot of times people get those ages mixed up. 13, child tax credit, or excuse me, dependent care credit. Under 17, all right? So when I say under, I mean in the year they turn 17, you don't get it, okay? Under 17, child tax credit and additional child tax credit, okay? Under 19, earned income. Under 24, earned income as long as they're in school, okay? Hold on one second here. Let's see, there will be no EIC for the custodial parent and giving the 40/50 exemption. Yeah, the exemption goes away for the non-custodial parent to the EIC. Things will work pretty much the same, but they're giving the child tax credit away for with the 8332 when you release that exemption. Okay. Let's see here where we at. Oh, Part C. This is another one that people don't realize a lot of times with the earned income credit. You must be at least age 25 and under 65. So sometimes grandparents are claiming grandkids, and once they reach 65, they can't figure out why their refund decreased. Well, if their income's such that they're under over 65 and still working with earned income, they no longer get the earned income credit. Okay. All right. So that's all those rules on there. Okay. And again, this is a little more specific about the rules for qualifying for the EIC. We have all those, and again, meeting all those tests and everything, the qualifying child, those are all things that are very important. All right. There's some examples, here that talk about John and Janet Smith when they're filing their daughter Amy. They lived with her. John worked, made $9,500. Janet worked part of the year, made $1,500. So their earned income was $11,000. They qualify for the earned income credit. So we have the little sheet there that talks about it and where we have the calculation. You can see the earned income credit, the Schedule EIC, that we have the child's name, social security number, their age to prove that. Again, here I talked about was a child under age 24 at the end of the year, a student and younger than you. So again, that's that threshold I talked about with the age. They could be over 24, but they would have to be deemed by somebody, probably a doctor or somebody, that they are permanently and totally disabled. So you could have a 26-year-old child on your return for earned income credit if they are permanently and totally disabled. Okay. We have the relationship test and the residency test. So you can see these all work just about the same when we talked about qualifying child. We have the calculation here of the earned income credit. In this case, with their $11,000 of earned income between the two of them, they get a earned income credit of $3,400, okay, which is a pretty good situation. All right. Okay. Now, this one I got to pound home. This is, I guess I have to put on my dad hat. And this is the one I have to tell you to make sure you behave when you do this. All right. There's no gray area when you get into this one. And that is the ethics and due diligence as a tax preparer, or even somebody that's filing taxes. You don't want to mess with this one. Because again, the IRS will crack down. This is one that they look for fraud and they will do audits on. Okay. And as it says here, the IRS can also ban your client from claiming the EIC for 2 to 10 years. So if you think about it, all of a sudden my child's 5 years old and I fraudulently file a EIC and the IRS says you don't get it for 10 years, and I had a $3,400 EIC each year, that's $34,000, dollars. That's a lot of money that I left on the table because I was trying to take it when I shouldn't have. Okay, so make sure that you do it and meet the requirements for filing it. As a tax preparer, you have due diligence. So they can penalize you $500 for you and your employer for each failure. Okay? All right? And that is now 510. So basically what I'm saying is that don't do it. Make sure you do your due diligence. And we're going to talk about things that prove that here in a second, but make sure that you're going through that. Okay? All right? So we have all that. Okay? All right, and there's a form in 8867 where you meet your due diligence requirements. For those of you who've done problems, if you've had any of the problems when your income has had somebody that's qualifying for the EIC, I'm sure that the tree on the left is lit up red with all these EICs and 8867s to meet this, okay? That's your due diligence checklist. And basically on that, you have to say that everything that you did to interview the client to make sure that that child or that qualifying child, or even if the case of their income, their EIC, if they're single, that it meets the requirements for it. Okay, and just again, when you have this due diligence checklist, read these questions, understand what you are asking and what you're being asked to do. You have to make sure on that information. We're going to talk in a second here about the records that would have to be kept or the things that would apply to it. Okay. Here's the documentation I was talking about. And again, earned income credit is for lower incomes, or basing on your filing status or your income and a number of possibly qualifying children. This is what gets you the credit. And one of the tests is residency. They have to live with you. You don't get an earned income credit for you're claiming a child, but they're living, you're separated and they're living with mom and not living with you. You don't get that earned income credit, okay? Now, school records used to be great because the day and age of report cards being mailed home, it said, to the parents of Susie Smith. And it was mailed to their house, and it had Susie's name and Susie's parents and Susie's address on it. This day and age, most of the time you don't get report cards mailed home. All right, if you even see one sent home, you have to log into a student portal and get into see that, and it's not on there. Okay, landlord or property management. If somebody's renting, a lot of times they have to list who is going to live in the residence. That is one. Healthcare provider, your doctor. Medical records, the same thing. Health insurance is another one. Health insurance cards, that may show. But again, just the card's not enough because it might only show the taxpayer's name and the dependents, but I don't have an address. I don't show where they live. Okay? It has to show all of that. Social service records, those are good ones. If somebody's of lower income and they qualify for the earned income credit, they may be receiving SNAP or HEAP or some other social assistance. Those applications, a lot of time for them to apply, and what's sent, that's sent back to verify that they qualify, shows everybody living in the house with everybody's name and everybody's address. Okay. Child care providers, again, these are great ones. Somebody that has doodle bugs and they have their child there, it's going to list who's paying the bill, mom and dad, their address, the child's name, their address. I've had instances where people brought this in and say, here it is. And I said, this doesn't match. Okay, this is somebody else's address. Well, the mail goes there. I can't take it. My due diligence says I have to have something that shows that the qualifying child may live with you in your name, your address, their name to verify residence. Okay, so we have everything there. All right, some other ones with place of worship. Employer statement is a good one too. Make sure an employer, if they do it, that, this is a good one because a lot of times somebody that works that has health insurance through their employer may sign up for health insurance and list their dependents that live with them to claim them on their health insurance. That's a good one too. Okay, but again, I can't stress enough all the due diligence requirements that you need to do here. Okay, great examples talking about things that you should do to make sure that you ask the right questions. All right. Okay. There is a way to get refundable credits back after you've had them disallowed. So that's what this one is. Again, these refundable credits, we've talked about the earned income. We're going to talk about the additional child and the American Opportunity Credit. Okay. Some exercises where you'll kind of go through and take a look at the EIC and calculating it and doing the forms. Again, we'll see this more so in the computer when we have it in there. Okay. All right. Okay, the additional child tax credit. Real quick, this child tax credit for 2017 is $1,000, okay? And it is fully refundable. So what I'm saying is when we talk about the non-refundable credit, we'll talk about the child tax credit that could eat up your tax bill, Pac-Man. And we also have a refundable portion that is the additional child tax credit that could be up to that $1,000. So if I have no tax bill, my income after the standard deduction is zero, and I have a child, then I don't have anything that $1,000 child tax credit is going to eat up. All $1,000 can come to me refundable in my tax return. Okay, so that is the additional child tax credit. It is a maximum of $1,000 per child, and on the return, so it's fully refundable. Okay, and again, due diligence on it is almost the same as the EIC. All right, because chances are this is an area of fraud that goes right in, excuse me, dovetails right in with the EIC. They tend to work in tandems, okay? American Opportunity Tax Credit, okay? Used to be called the HOPE credit many years ago. It's a college credit for education. 40% of it is refundable, okay? It is a $2,500 credit with 40% or $1,000 refundable, okay? We're going to get into it and pick it apart a lot more when we get into the non-refundable credits next week, because we'll be talking about American Opportunity and Lifetime Learning credits that are the two college ones. But just know that there is a refundable portion of $1,000. Excuse me. We have the credit for excess Social Security tax. Again, we talked about that when we did the original one. The big thing to remember about the excess Social Security, 2 or more employers. If I only have one, my one employer took too much Social Security, I go right to the employer and get it back, okay? If there's 2 or more, then I can do it on the tax return. The little table there in the middle shows that there is a difference. Depending where you work, some of the clients, when I worked at the Akron office and Lockport office, I had a lot of railroad retirees. Many moons ago, I guess, when the railroads were the biggest industry in the country, they set up some different rules for them as far as how their retirement works. They basically get a combination of like a retirement pension and Social Security that's kind of together. So that's why there's a difference for the railroad one. Okay. All right. Again, credit for undistributed capital gains. Okay. Don't really see any of these. All right. They're just don't really see them. Just know the form that it would come to you on and that you have it. That form is in the TaxWise software, that it would go on line 73 for that credit that is there as far as a refundable credit. Okay. Health coverage tax credit. This one you don't see very often, and this is not the credit that you receive under the Affordable Care Act or ACA, the healthcare marketplace, whatever you want to call it. This is not that credit. This is a different credit. This is a credit, and most often you see it with Delphi up in the Lockport area. They had the bailout at one point. Part of that bailout was for some of the things we're restructuring with the benefits for retirees, and they get a credit to help pay for their insurance. Another time this credit comes into play is if I have a worker that his job or her job has been displaced and sent overseas. Say I'm a special welder and I have a special skill, and my company closed because of foreign competition and my job went overseas. I can go be retrained, and while I'm being retrained, I can get this credit to help pay for my health insurance for myself and my family. Okay, so those are two of the best examples. All right, but just remember, it is not the credit that you see on the marketplace for the Affordable Care Act. Okay. All right, and again, on the form here that you see that you work out the 8885, in the middle you see the months, because it could be the case that they were retrained for 8 months, and during that 8 months, this is when they get the credit. So that's why you see the months there in the center. Okay. All right. So here's what we're going to do. I am going to. Do I have any questions for anything from Chapter 5? Because I'm going to do a couple problems, one from 4 and one from 5, and talk about some different things that we talked about, go into them a little bit more depth while the software is in motion. So that should help everybody with that. Okay. All right. But again, if you want to holler out some things, especially while I'm doing the problems here, if you want to unmute your mic and talk, that's great. If you want to type them in the chat, that's great too. Okay. All right. Okay. All right. So we're going to head into my software here. Okay. Okay. All right, so we are going to do a return here. If you have your workbook, if you want to kind of see what I'm doing here, it's on page, the workbook is the one with the problems, the computer problems. I'm going to be doing class problem 4.1. It's John Sampson. It's on page 4.7, okay? Okay. Just waiting for things to load up here. Okay, we had a question about exercises and homework. Okay. When I refer to exercises and quizzes, typically I am talking about the things in the textbook. Exercises and the quizzes are in there with the reading in the textbook. When I'm talking about the problems, that's out of the workbook. The workbook is the one that has documents in it that look like tax documents and has a little computer help things, okay? All right, so put my social security number in there twice to get the problem up. Okay. All right. All right, so we're going to go through the problem. And again, if you want to unmute and holler while I'm doing things, or even in the main info, or type in the chat, you're welcome to. Always make sure that your cap locks is on. Like I said, there's funny little quirks about the software, and one of those is that it likes everything in caps. Okay, so I'm going to put John in there. Right now, I don't have any spouse's name, so I'm kind of looking at the things on 4.7 and 4.8. Those 2 pages there. He is living on 76 French Road, and that is in Lancaster. So once I type in that zip code, it'll fill it in for me. He did give us an email address, and like I said, I stress that if you have a client, get their email address, because it is the case that if they would call and ask you to email, you have to have it on file. They can't give it to you over the phone. We got the phone numbers in there. Okay. And he did give us his cell number. All right. All right. And he's giving us his age. And his date of birth was 8/2/1994. Okay. Okay. Somebody had a question about the percentage. I kind of skipped over that line, but name line 2 here. If I come down, and this was a case of a married return, and down here a little farther, that one or the other passed, as far as that spouse had passed, okay? That would be where this would light up. This is care of, okay? So basically, if I have a joint return and one of them passed, I would put the percentage care of and then put that on there. If it's a case that John Sampson died and I am the executor or the administrator of his estate, it would be the percentage standing for care of in my name. Okay, so basically that line is for something, somebody that has a deceased person on the tax return. Okay, his occupation, he is a cook. All right, and looking at 4.8 shows no dependents and him by himself. So we're going to do a single for his filing status. All right. As we go down a little farther here, this may be red in yours, but we have to decide what state full year residence is. In this case, he's a resident of New York. I know on the class we have a couple individuals from Florida. They do not do personal income tax in Florida, so you can actually skip that one, so you don't have to do a state return there for them. Okay. All right. For taxpayer and spouse, is there any convention relative to amount of income? No, as far as anything. A lot of times it'll carry forward. All I want to know when I do the tax return, as far as who's the taxpayer and who's the spouse, that way whoever is listed as the taxpayer is the one that the file and possibly any notices that would come from the IRS, that's whose social security number will be attached to the return as the taxpayer. The spouses will be on there of record too, but the primary, again, for a tax return, you probably could call them primary taxpayer and secondary taxpayer. First tax, whatever it may be, but there's nothing that has any specifics on that, okay? In this case, when we read the one bullet point, says that if John gets a refund, he would like his deposit into his checking account, okay? If he owes any taxes, take it out. This is a case right here. We're on here. We have his bank account information, and we'll put that in. And we have his bank account number, and we will put that in because that's where, if he wants to have it paid out of there, we can do that. And if he wants it deposited there, we have his account number for either one of those, okay? A lot of this will be defaulted, this area here, so don't worry too much about it. Most of the time we're going to be doing this, checking this box that says income tax return, unless the 4868 we can remember is for extensions. Taxpayer's PIN number is always a 5-digit. I like to use their zip code just because it's a 5-digit number that they probably can easily remember. All right, and we put in the date that we're doing the return. And this little part is what will go on the printout if you've noticed, if you've printed any of yours with the electronic signature page. ID verification. You will do this when you do returns for live because you'll have somebody's driver's license. On these, we don't have any driver's license information. So we're just going to say they do not have one for this time. Okay. And because they did not have one, we use something other than a government ID to say that they are who they are. Okay. Maybe they brought in their library card. I don't know. Okay. All right. Down at the bottom, preparer's ID, you're going to use your initials. Once you do that, everything else will auto-populate. Again, if you want to come back and look at this and type those in, your PETN numbers and the EIN numbers, those will be assigned later. But you can go in there to fill the information out on there. Okay. 30-part designee, again, will be filled in later. Okay. On the tree, I use the tree all the time. You'll see me over here clicking on the left to do my navigation because that's where I like to see the forms, okay? On this case, my first bullet point on page 4.7 says John filed a 1040-EZ last year. Well, 1040-EZ, okay, I have, all right, my 1040-EZ over here, he filed a 1040-EZ, and again, always do everything on the 1040. I just want to make a note of this. Right here on the main info sheet up at the top, it says this return can be filed on Form 1040-EZ. Do not change it to 1040-EZ here. Do all of them on the 1040, okay? Just because it's easier because you have all of everything in front of you, all right? But John did file a 1040-EZ last year. So in my middle box here, if he was on an EZ the previous year, that means he did not itemize. So did you itemize last year? That would be no, okay? So we don't have to worry. We talked today about that unearned income, that state refund, but he did not itemize, so he does not have to claim anything, okay? On this too, it talks about the full-time students did not receive distribution from a retirement plan. We'll talk about that when we do a W-2 about the 8880. No EIC was disallowed or reduced. That's part of our due diligence. The next bullet point does say that he had health care the entire year. If I look on my tree on the left, I'm going to light it up in blue here and click on it. This is our Affordable Care Act worksheet. Okay. Basically what this one is saying is, did he have health insurance? Okay. He did not get it through the marketplace. The second question is, if they did not have insurance all 12 months, are they asking for an exemption? We're going to say no on that one. And then these 3 boxes that are after John's name, okay? These are the boxes, and this one says that he had minimum essential coverage the entire year, okay? Again, the other boxes and the exemptions and the marketplace we'll talk about later, all right? And then there's another bullet point that says John has bought $52 worth of losing lottery tickets. I guess he's a gambler. We'll have to look at that, okay? All right, so if you turn to page 4.9, he has W-2 income, okay? I know we had a question earlier about the quick link. Again, you can do different things, but most of the time I go right to the tree on the left, and I have that W-2 there, okay? If he had a second job, all right, if he had a second job and you needed to add another W-2, all right, I would go, if I were you, right up here to this little tab. It says copy W-2, okay? And the reason I say that on this one, all right, I'm going to do this. Let me get his W-2 started here. Okay, his address was correct on the W-2. We have his employee identification number. Now, because I've done some of these problems other times, this name code and the employer name down here will autofill. You're probably having to type yours in because there's no database in there with all the different EIN numbers, okay? I'm going to put his income. All right, so I have his income in there. I'm going to go down here. This default, the 414H SUB, for right now, just delete that out. We'll cover that when we get to the retirement chapter, okay, the retirement account chapter. And then down below, always remember to go down there and look for this. Again, our Florida residents won't have anything on here, but New York State, you know, make sure that we have that there, okay? So that's where it is. And always make sure you go, because a lot of times people have this picture right here doing everything, and they'll kind of forget, out of sight, out of mind, that there's those other boxes, 12, 13, and 14 down below, okay? Now, John's income, all right, well, let's go back here, okay? Now, John not only works at Yum Yum Taco, but he moonlights at night against his with his competition, Mighty Taco. So again, I'm going up here to this white tab at the top. If I need another W-2, if I hit copy W-2, it gives me a fresh, clean W-2 to fill out for him, okay? And if you look at my tree on the left, you can see I now have 2 W-2s. So that's one way to get that W-2 a little quicker, okay? Now, back to the Yum Yum, okay? We're going to make an example. We're going to say that he contributes $1,000 to his retirement, okay? Once I did that, if you notice on the tree on the left, his 8880 lit up, okay? All right? And that has to do with retirement. So we're going to do a quick look at this. This is not part of your problem. This is just kind of for an example for you. The one bullet point says that he was not a full-time student. So to qualify for this credit, he has to say no, okay? And here it's asking in the last 3 years, or it said, I'm sorry, in the bullet point, that he did not take a distribution from any retirement in the last 3 years, okay? Just so you know for this one, if you guys haven't discovered, F3, and it says if 0, that's get your red out button, okay? I call it the Visine button, all right? So if you look, he gets a $100 credit, okay? For that 1,000 that he had contributed. That's what's called the saver's credit, okay? A lot of times you hear people call it the saver's credit, all right? But we're going to take that guy out of there, okay? All right, so we have his W-2 there, all right? On 4.9, the next document we have is some interest income. Again, I'm somebody that navigates off the 1040. You can do it however you'd like. If you want to go up and add a form and know it goes on a Schedule B, that's fine. But if I go here, he had some interest. All right, so we have interest on savings bonds. Well, I'm going to go in there, and I like to go over here, and I like to use F9. What can I do from this line? What can I use? Well, there it is. I know that my interest goes on a Schedule B, okay? So this is going to bring my Schedule B up in front of me. All right, now, we're going to talk a little bit about this Schedule B. Remember when I said about somebody holding the mortgage for somebody else? If you take a look, right up here at the top, seller finance mortgages. So basically, there it is. I have to claim that interest income from that mortgage, okay? So we have on that, all right? We're going to talk about this other interest that we're in here. Now, even though I've told you that interest and dividends go on a Schedule B, for the sake of our software, interest and dividends go on the Schedule B, but they do not go on the Schedule B, okay? So I'm sure that everybody's going, now he's losing his mind, now he's confusing, okay? What I'm saying is, this is an instance where I'm going to go in here and I'm going to get a worksheet, and I'll show you why in a second. That's why this is. Same thing for dividends down below, okay? So I'm going to go into that B and I'm going to get an interest worksheet, okay? If you notice, now it looks a lot like my 1099 INT. It talks about box 1 or 3, okay? In this case, on page 4.9 in your workbook, we have something from First National Bank, okay? and it's in box 3, so it's savings bonds. And he got $541 in interest from his savings bond, okay? But what do we know about box 3 and what do we know about state savings bonds? All right, we know that there's an adjustment on the state, okay? So if I go over to this column, you can see right above it, there's a plus and a minus. If it's non-taxable, it's negative. If it's taxable, it's positive. All right, so non-taxable, it's an N. Negative, that's an N, okay? If it's taxable, that's a T. The plus looks like a T, okay? So that's the way I want you to remember that. So we're going to put negative in there and 541, because on the state, we don't have to pay tax on that, okay? So I'm going to show you what happens with that, all right? So if I go back now to my Schedule B, all right, you can see there's my interest. It got to my B, but I did it on a worksheet. All right, down here, if I have dividends, I'll do the same thing. I'll go in there, I'll hit F9. I give a little dividend statement or worksheet. All right, if I go into that, then here's again, I have a little thing that I can do all my dividends, and you can see these are all those things we were talking about, either on a K1 or dividend that we have with ordinary dividends, the adjustments, things like that, capital gains, exempt interest, all those different things. So it looks a lot like my statement, okay? Now, I'm going to go to the 1040 page 1. Again, I'm using my tree on the left. I got there. Come down here. Here's my interest. Great, okay? So I have my interest, all right? Now, I'm going to go over, and for those that are doing New York returns, doing the New York here, and I'm going to go to page 2, all right? So I have that. I got my wages. There's my interest because the New York uses, you can see here at the top, federal adjusted gross income on line 19. All right. However, if I go down here, I get to subtract out of my income in New York interest on U.S. government bonds. So that reduces my income that I'm going to use for tax in New York. Okay. So that's why we do it that way on that little worksheet. All right. Okay. Now, one last thing we have, going back to my 1040 page 1, and if you go to 410 in your workbook, okay, this is the problem workbook, and I go down here, I got my income section, and I have gambling winnings, okay, and it doesn't have a line anywhere between 7 and 20 that says anything about gambling, all right. As far as unearned income, we can see the line for unemployment. We can see Social Security, things like that. Again, we'll talk about some of these later with retirement. Here's that other income, amounts from WG. It's got a little thing. So I'm going to go in there, light it up, hit F9. Oh, there's a worksheet. Let's see what the worksheet will do for me, okay? So I have my worksheet, and again, almost looks like another tax return. Real quick while we're here, this is the spot where the W-2, we have some 1099 miscellaneous that would go in here. Foreign income exclusion we'll talk about later. We have some things that about medical savings accounts, long-term insurance. We have jury duty, things like that that are on here. Here is one that says describe. If I had cancellation of debt, this is where it would go. 1099C, and I would put that cancellation of debt, okay? So I have that and say that he had $2,000 in cancellation of debt, all right? Now, remember I talked about the fact that you can do a 982. So this has a cancellation of debt, but I've determined, or I should have determined, that John is insolvent, all right? The way that I would do that is if you go to our website, there is a little sheet little asset worksheet here, okay? And I'm going to open that guy up. All right. Okay. Okay, so on this, on our website, there's this little sheet, and this is what I was talking about. Okay, it's on there. It's an asset and liability worksheet. Here's what they own. Here's what they owe. If I get down at the bottom and that is a negative number that they owe more than they own, that person is insolvent. Okay, so going back to the software here, I have the software on there, and I am going to go up to my Add a Form tab at the top. All right, and I'm going to know that I have to get 982. That's that form I was talking about. Okay, so it brings up my 982. If I look right here, discharge of indebtedness to the extent insolvent. That's where I'm going to check that. And I'm going to say all $2,000 because he is insolvent. All right. So again, 982, I got that. If I go back to my worksheet 7, that's where we had this cancellation of debt. Below it, I'm going to type form 982, and I'm going to put a negative 2,000 in there. So that way I just got rid of it. But you can only do that if they are insolvent or bankruptcy, okay? You can't just say, guess what, I'm going to get rid of it for you. And the IRS audited him and says, no, they're not insolvent. He's got a $100,000 retirement account. He could have paid that. Okay, that's basically what they would say. All right. In our example here, we have a W-2G. So we're going to go up, W-2G, and just a kind of a little navigation thing. If the number, let me get out of here. If the number in the box is yellow, that means that that box is calculated by linking to something else. If the number is green, that means you can enter it directly. In this case, we're going to go get our W-2G. Okay? And it looks very similar. So this was for our taxpayer, John Sampson. The address on there is correct. Okay, we're going to put in the ID number for that one. He had winnings of $421.11. He won that. He must have been out for a New Year's Eve celebration. Okay, and he won it. I guess not. Must have bought on the way home. New Year's Eve lottery. Okay, so we have that. We have that he won. You know, we have to claim the state winnings the same. Okay. Now, if we remember on our bullet point, there was $52 worth of losing lottery tickets. So I have gambling losses, $52. Okay, so I can put that in there. All right. Okay. And if we look at our Schedule A, and again, we'll cover this later, you can see that putting that on there, the losses came over there, but he doesn't itemize because he's below the standard deduction here for his total itemized. So that's not going to help him. He's still got to claim the income. Okay. All right. So there is John Sampson's return. Okay. We're going to clean up a little bit on the New York side. On their page, they have a little thing that talks about the county of residency that he lives in. Again, this is unique to New York. He is in the Maryvale. And again, I'm getting this off of 4.8. And he is in the Maryvale school. 378 is their school code. Has a couple questions about having banks in Switzerland or the Cayman Islands, I guess, foreign countries. And if he was a member of the state deferred comp. All right. And these last little things talk about the refund down here. I can say that I'm going to send it to the same account as the federal. That is a personal, and it is not located in the Cayman Islands. And again, the bottom parts, these will be all defaults. The only thing that's left that I really want to clean up is if I look at my 1040 page 2, and I go down to the bottom, all right, he owes money. And it has said in the bullet points he would like deposit. If he owes money, he would like it, a withdrawal from his checking account on April 15th. That's what this is right here. So I'm going to say yes. All right. And that gives me this little form. I'm going to pay his balance due. All right. He owes $157. He's going to pay that $157. I have his bank account information. It is a checking account that it's paid out of. And the account number we have on there. And the request the payment date, it said that he wanted to take it out on April 15th. Okay. All right. Now, if I do diagnostics on this one, it's not going to allow me because it's a date in the past. All right. So that would be where that one's at. Okay. All right. Any questions on that one? That's John Sampson. I know I go through them pretty quick. I don't want to keep you guys all day, but you can come back and watch the recordings on these and, you know, kind of see where we're at with those. Okay. All right. Okay. All right. We're going to do one more problem here real quick. Okay. And on this one, okay, I am going to, if you want to go in your workbook to page 510, this is class problem 5-2, George and Jean Van Etten. Okay, so we have George and Jean Van Etten. All right, and I'm just going to bring this one up that somebody had already done so that we don't have to worry about typing everything in, and I'll kind of show you some things on this. Okay. All right. So we had George and Jean. They're living in Washington. They're a manager and a hostess. They're doing married filing joint. They do have a daughter named Amy. March 13th. She's 20 years old. Okay. She lived with them. She's their daughter biologically. Has a social security number. Okay. The EIC here, I always want you to check that box. If you notice, the child tax credit box on the right is not checked because she does not qualify. Okay. She is 20 years old. All right. So she does not qualify for the child tax credit because she's over 17. All right. Again, we got New York. We have some bank account information for them. Okay. So that is in there. All right. And we did their PIN number for everything on there. Again, we just skipped the driver's license on everything on that. Okay. First bullet point says that George and Jean filed a 1040 last year. Well, 1040, again, it says right there they were able to itemize. All right. So if I go to the middle here, I can see, yes, they did itemize. And there's where I would enter the 287 on line 10 for that state refund. Okay. So they would enter that right on there. All right. Okay. Next bullet point says if George and Jean, again, I'm on 510, if they get a refund, they would like a deposit in their checking account. They'll send a check, so they're not going to do like we did on the last one. The other thing that Amy is in her third year full-time at Buff State. Amy has never been convicted for the felony possession or distribution of a controlled substance. Kind of a random statement, but we'll talk about that in a second. Again, George and Jean, neither was a full-time student and no distributions. We talked about that 8880 that we've seen. No EIC was disallowed or reduced for 2016, and they had health insurance. So again, health insurance, we've gone to the ACA worksheet. We have checked those two boxes, no, in the top right. Here after each of the names, they had insurance all 12 months. Okay. We have, if you look at page 512 in the workbook, George works for a sub-delivery company and Jean works for Steak on the Grill. Okay. So we have George. We checked his box for the address. We entered his employee ID. Okay. On this one, he contributed $2,000 to his retirement. That's what that letter D means here in box 12. All right, we check the retirement plan, and we have all right, so that we have that, okay? All right, we have steak on the grill. Same thing, we fill everything in there for them. We had a retirement of $1,000, their state and everything. So if we look, they both qualified for the Savers credit, and they get a nice $300 that they get as a credit, okay? All right, and that is a non-refundable credit, but they get as a credit on their tax return for the saving money in their retirement, okay? The other thing that we had, if you go to 513 on this one, is we had some college credit, okay? So on that one, we're going to go here, and we're going to go down, and in our non-refundable, line 68, we have the American Opportunity that we talked about, and it says Form 8863. We see we have a number there, but let's see where that number came from. So I hit F9 in the box, 8863, and again, this one's already been completed, but we go to the 8863, and we have, in this case, Amy. We type in her social security number. It says she went to Buff State on Elmwood Avenue. It asks in question 2, did the student receive a 1098-T? Yes. All right, box 2 filled in. No, we're going to say no on that one. On that 1098-T on page 513, we have an EIN number. All right, these are where we're going to ask our due diligence questions on the form for college. We'll talk about these more in the next chapter, but here's a preview of them. Did she receive the American Opportunity credit for 4 years? You only get it for 4 years. No. It said that Amy was in her 3rd year. So this is a little thing, trick I'm going to teach you, okay? We have F7, and I hit that. It brings up a little box that has information about the return. You go here in the middle where it says General, and I slide all the way to the right, there's something called Diary. Well, there's a space here, and these are not seen by the taxpayer. These are just for the tax preparer. I'm going to add a note. It date and time stamped it for me, and who was the user. I'm going to say Amy in 3rd year at Buffalo State College, okay? And then I'm going to hit Save Note. The reason I do that is these notes carry forward every year with the taxpayers. It's a great note because next year, if they say, well, she's in her 4th year, well, I don't know. I can go back and look at the note. Yep, she only claimed 3 years prior. This is her 4th year. She can still take the credit, okay? So we have that. We have the, was the student at least a half-time student? Again, I look at my 1098-T on page 513, and box 8 says check if at least a half-time student. Yes. Did the student complete first 4 years of post-secondary education? No. Okay. Was the student convicted before the end of 2017 of a felony for the possession or distribution of a controlled substance? Well, as it said here, it said no. A little story I want to tell you about this one. I had a client that was sitting there, a young lady. She was out on her own, not on her parents' return. She sat down to do the tax return with me. Her friend was there. Her friend was constantly on the phone, never talked, never said a word. We're going through this. She handed me her slip. She was going to Niagara County Community College. I get to this question, and being a good tax preparer, I did my due diligence and said, have you been convicted for the felony possession or distribution of a controlled substance? The young lady I was doing the tax return for says no. Her friend, who's been on the phone the whole time, hasn't said a word, looks at her friend and goes, what about that time last year when you were arrested because you were in the car for possession with your friends? So her friend threw her under the bus. I could not do the return and give her the credit. And she got up and left and walked out the door. So that's where that due diligence comes in, okay? Now, down below, I have the American Opportunity Credit. She qualified for it. So this is red, and I can put a number in here. Now, in this case, like I said, this spot would be red, okay? I look at the 1098-T, I'm going to use box 1 that says payments received. But I only get to take the payments that are out of pocket. I was given $6,000 in scholarships. So, and that's in box number 5. If I light this box up and I hit F5, that brings a calculator up for me. So I have 8214, all right, and I have to subtract 6,000, okay? And if I hit enter, if you notice, it enters the number right in for me. So I have 2214, okay? That gets me the credit on that. All right, and then I hit enter again, and that gives me the credit for that. All right, so now I have that education credit. On the tree on the left, you will see here, there's some red things here that lit up. That's the 8867. If I go look at that, at the top, it's a due diligence for the earned income credit. It's not checked, they didn't qualify. She's too old for the child tax credit, but it did check it for the American Opportunity. Again, due diligence has to be done on this, okay? Now, the other thing is, if we look way at the bottom on the tree left here, I'm going to light it up. I have a college credit on the New York return. So I'm going to complete this, saying that she was a student on my return. She is an undergraduate, and I'm going to put the tuition in there. All right? A little New York State consideration on this one. On page 2 of this form, you can take this college tuition as either an itemized deduction or the college tuition credit. If I choose my itemized, you can see that it drops my return to $1,900. If I take it as a credit, I get $2,141. So I'm going to take that as a credit so that I get a little bit more. Okay? All right. And that's about it on that one. Okay? All right, so that's problem 5.2. All right. So we've covered a lot. Any questions about this return? I know it was pretty much filled in. I just didn't want to keep you much longer, but I wanted you to be able to see another return so that if you have to come back and review it, you can. Okay? All right. All right. Any questions from anybody about anything? All right. Nothing on anything specific or anything there. Again, you know, I'm sending you these links, and I gave you the link to the EG Tax Web. I encourage, I pick up a tax book. Give me a call on Monday, David, just to make sure that we have a textbook here. Some of them are at the learning places, the other classrooms, but give me a call Monday or call the office here and talk to Tammy and see if there's a textbook that's here at that time. We are moving to new corporate offices over on Colvin Boulevard, so some stuff is here and some stuff has already started to be moved to Colvin Boulevard. So just call before you come over so that we're not sending you on a goose chase there, okay? But as I said, I send you the links through the EG Tax Web. I know we cover a lot of material in a short time on Saturdays, and I'm just trying to highlight the very important points so that you have that. Again, there's a recording. You can come back and review this. If you go to that EG Tax Web on YouTube, our videos there, I have recordings that are just specific chapters. I have through chapter 6 already up there. I apologize. We have no idea. It's somewhere in the cloud, I guess, and I can't find it. But chapter 4 disappeared on me. But chapters 3, 5, and 6 are up there. And again, it's where I record and make about a 2.5-hour clip on my classroom time. I go through problems. I'm trying to do different problems with you guys that I would do with the classroom ones so that you see different things. so that you see a lot of different stuff. Again, if anybody's struggling and they just can't get the software, call me. I'll set up or text me, I guess would be the best. Like I said, during the week is best to text me so I can get back to you, with appointments and stuff. And like I said, we're moving. A lot of things going on during the week, but text me would be the best. And then I can get with those on there, okay? Deb, same thing. It depends on what was set up. I don't have here in front of me what that was, so we'd have to see. Give me a call on, or talk to me or Tammy on Monday, and we can see if there's any extra textbooks around, okay? Again, I just don't want to commit to them because I don't see. Some of them are at the other classrooms, or like I said, they might have been moved and I don't know yet. So, okay. All right. But again, try to use all the resources. Everybody's doing great. Homework's great. As I talked about at the outset, make sure that, you can turn in that homework any way you want. The exercises out of the textbook portion, as far as that. Again, I'll be sending out the homework assignments. There may be only specific exercises I want to see at this time. So we may just see those specific ones. As far as anything else, as far as problems, I may just give you a couple problems that I'll have you turn in out of the chapters that we do, and I'll have the homework for the following Saturday. Again, homework-wise, you need to do it. You need to do the reading and do the practice. If you can't get it turned into me, as far as, turning it in, typing and things like that, I understand there are things in life happens. I know a major portion of you have other things going on or other jobs and such, but I do appreciate all the efforts that you put in. So, okay. All right. Seeing that there's no other questions that have come up, again, when we're doing the lectures, if you want to pop your microphone off down in that left corner and holler at me, that'll be great, okay? Do we turn into you both exercises and workbook homeworks? Yes, they'll come to me. Again, I'll send the email out with everything on that. Like I said, I'm going to try to add a couple things. I have some other sheets that I did for my classroom things with stuff for the homework and stuff. Okay? All right. Well, again, I appreciate everybody's time this morning, and we'll see you next Saturday. Any questions come up, again, text me or email me, and we'll try to get them resolved for you. All right.